Welcome to Charged Alpha. I'm Hudson, joined by Lana. Today's chapter, Dynatrace, the AI observability platform that closed fiscal 2026 with accelerating platform revenue as cloud intelligence becomes non-negotiable.
Dynatrace was founded in 2005 in Linz, Austria, as an application performance monitoring startup. It spent over a decade as PE-owned before listing on the New York Stock Exchange in 2019.
Dynatrace IPO'd on the NYSE in 2019 at $16 per share, raising $570 million. The transition from legacy APM to a cloud-native SaaS platform drove years of re-rating as the product matured.
Rick McConnell has served as CEO since 2021. He spent over a decade at Akamai before joining Dynatrace to accelerate the AI platform transition and expand into enterprise AI observability.
Most recently, Dynatrace closed fiscal 2026 with quarterly revenue of $472 million, up 20%. Annual recurring revenue reached $1.86 billion, growing 18%.
The AI platform tier drove outperformance. Enterprises migrating from classic observability showed higher contract values and faster account expansion, validating the platform upsell motion.
Dynatrace's moat is the Davis AI engine. Davis ingests trillions of dependency signals in real time, automatically identifying root cause across applications, infrastructure, and business transactions.
Grail, Dynatrace's proprietary data lakehouse, stores causally connected logs, metrics, and traces at infinite scale, enabling business context queries that log-only platforms cannot produce.
The long-run thesis is platform consolidation. Enterprises replacing fragmented point tools with unified Dynatrace create deep workflow dependencies, driving the high net revenue retention that powers the model.
Against Datadog, Dynatrace competes on causal AI depth. Datadog leads in developer mindshare, but Dynatrace's automation delivers deeper root cause analysis at enterprise scale.
Cloud complexity grows faster than IT teams can scale. Every microservice deployment and AI workload generates exponentially more telemetry, making automated observability a structural enterprise necessity.
The near-term risk is competitive pressure. AWS CloudWatch, Azure Monitor, and GCP operations expand capabilities annually, raising the bar for standalone observability vendors like Dynatrace.
Hyperscaler encroachment is structural. If AWS or Azure bundles observability deeply enough, enterprises with single cloud commitments may reduce standalone Dynatrace spend over time.
Enterprise sales cycles remain long. Large observability deployments require deep IT integration and multi-stakeholder procurement, making quarterly revenue timing inherently unpredictable.
The AI security expansion is the medium-term catalyst. Dynatrace's application security module adds runtime vulnerability detection, a new budget pull on top of the existing observability sale.
EMEA and APAC are growing faster than North America, diversifying Dynatrace's revenue mix beyond the U.S. enterprise base and expanding the addressable market.
At $19 billion in market cap with 28% free cash flow margins and expanding AI platform cohorts, Dynatrace's premium is increasingly supported by durable and growing FCF.
Dynatrace just closed fiscal 2026 with accelerating AI platform adoption. Observability has become a mission-critical AI spend category.
Let's get into the platform transition and what Grail's AI analytics capabilities mean for the expansion opportunity.
AI observability, causal analytics, and platform consolidation. Dynatrace gets paid every time cloud complexity grows. Now let's get into the numbers.
Dynatrace beat earnings, revenue beat, EPS beat, and the stock fell 13% on the same day. That is the software market in 2026. Execution is not enough. Guide lower than expected, collect a Guggenheim downgrade, and watch 13 points evaporate before the call ends. The company is doing its job. The question is whether the growth engine is slowing structurally or temporarily, and that is what this quarter makes urgent.
Welcome to Charged Alpha. I'm Lana here with Hudson. Today we're breaking down Dynatrace's Q4 fiscal year 2026, the observability platform that beat both top and bottom line and still got sold off 13% because the market is now pricing what comes after the beat, not the beat itself.
Quick orientation. Dynatrace, ticker DT, is headquartered in Waltham, Massachusetts, founded in 2005 as CompuWare spin-off Dynatrace with approximately 4,500 employees. Dynatrace's fiscal year ends March 31st, so the May 2026 report covers January through March 2026, fiscal Q4.
Dynatrace is a full-stack observability and application performance management platform. Its Davis AI engine automatically detects anomalies, determines root causes using causal AI rather than correlation, and provides actionable context to DevOps and SRE teams. Unlike tools that generate thousands of alerts for humans to triage, Davis produces a single root cause answer and the chain of events that led to it, a differentiation that resonates with enterprises running complex, distributed systems.
CEO Rick McConnell joined Dynatrace in December 2021 after leading Centrify and holding senior executive roles at F5 Networks and Akamai. He has shifted Dynatrace's go-to-market from a product-centric model to a platform-centric model, expanding beyond application performance monitoring into infrastructure observability, log management, cloud security, and the newer AI observability product targeting enterprises deploying AI agents and LLM applications.
Q4 FY2026 revenue was $532 million, up 16% year over year from $458 million. That beat the $518 million consensus estimate by 2.7%. Annual recurring revenue, the key SaaS metric, reached approximately $2.1 billion, growing at a similar 16% rate and continuing Dynatrace's track record of double-digit ARR growth.
Non-GAAP EPS was 41 cents versus the 39-cent consensus, a 5% beat. Adjusted free cash flow for the quarter was approximately $138 million, consistent with Dynatrace's history of strong cash generation relative to reported GAAP earnings. The GAAP net income includes significant stock-based compensation that depresses GAAP figures relative to operating cash reality.
Now, the number that mattered most on the call, FY 2027 revenue guidance. Management guided to $2.3 to $2.35 billion in revenue, implying approximately 13 to 14% growth. That is a deceleration from Q4's 16%, and it is what caused Guggenheim to downgrade from buy to neutral immediately after the call. The guidance miss, in the context of a competitive threat narrative, triggered the sell-off.
Net revenue retention is the signal beneath the guidance. NRR, which measures how much existing customers spend year over year, has been trending down from approximately 120% 2 years ago to approximately 113% in Q4 FY2026. That compression means each renewal cohort is growing less than it used to, which requires more new logo acquisition to maintain total revenue growth rates.
The platform expansion narrative is management's response to the NRR concern. Dynatrace has been adding AI observability, cloud security, and business analytics capabilities that are not yet in the NRR calculation for most existing customers. If platform cross-sell starts to take hold in FY 2027, it could re-accelerate dollar-based expansion and reverse the NRR compression trend. The guidance range does not appear to bake in a meaningful recovery.
Operating margins remain strong. Non-GAAP operating margin for Q4 FY 2026 was approximately 32%, consistent with Dynatrace's established profitability profile. Free cash flow margin of 27% demonstrates that the business model generates real cash even after all operating investments. The core mechanics of the business are not broken. What the market is questioning is the growth rate, not the economics.
Rick McConnell was notably measured on the Q4 call in addressing the guidance concern. He acknowledged the FY 2027 growth profile reflects continued investment in AI observability and enterprise expansion rather than business deceleration, and pointed to the pipeline of new platform capabilities as the source of re-acceleration he expects to emerge in the back half of FY 2027. Whether that confidence is warranted is the central question the market is asking.
Wall Street's view shifted materially on earnings day. With 12 buys, 8 holds, and 2 sells, the consensus is now effectively a hold after Guggenheim's downgrade. The average price target of $42 against a current price of $35 implies 17% upside, but the dispersion between bulls and bears is wide, and the downgrade creates a gravitational pull on the consensus over the next few weeks.
Guggenheim's downgrade to neutral cited 3 specific concerns: First, FY 2027 revenue growth decelerating to 13 to 14% from Q4's 16% suggests the organic growth algorithm is losing momentum without a new catalyst. Second, NRR compression from 120 to 113 signals existing customers are expanding less, which historically precedes further deceleration. Third, the competitive intensity from Datadog is intensifying precisely as Dynatrace's differentiation narrative is being stress-tested.
JP Morgan maintained their overweight, arguing that the sell-off is an overreaction to a guidance range that has historically been conservative. Dynatrace has beaten full-year guidance in each of the past 4 fiscal years by an average of 3 to 5%. If the FY 2027 beat pattern holds, actual revenue could come in at $2.4 to $2.45 billion, which would represent 15 to 16% growth, not deceleration at all.
Jefferies' hold reflects a wait-and-see position. They acknowledge the platform expansion potential, but want to see AI observability convert to material new bookings before upgrading. The product is compelling in demos. The question is whether enterprises are ready to pay incrementally for monitoring their AI deployments versus treating it as a feature of the base observability subscription. That monetization proof point has not arrived yet.
The broader market context matters. In a software environment where investors are paying 35 to 45 times forward earnings only for companies growing at 25% or more, Dynatrace at 13 to 14% projected growth does not screen as a high multiple candidate. The stock's compression from 40 to 35 reflects multiple normalization, not fundamental impairment. But for growth investors, the distinction barely matters at the moment.
The bull case starts with the guidance beat pattern. Dynatrace has set conservative annual guidance and beaten it every year for 4 years. If Q1 FY 2027 revenue comes in above $520 million and management subsequently raises the full-year range, the market will reassess the deceleration narrative. One strong quarter can flip the sentiment from growth is slowing to guidance was conservative again, and the stock re-rates accordingly from 35 back toward 42 and beyond.
AI observability is a genuine incremental market. As enterprises deploy AI agents, LLM-based applications, and autonomous systems at scale, monitoring the performance, safety, and cost of those AI workloads becomes critical. Dynatrace's causal AI approach, which identifies root causes rather than just surfacing anomalies, is uniquely suited to the AI observability problem, where correlation-based tools generate too much noise to be actionable. If AI observability monetizes meaningfully in FY 2027, it re-accelerates growth from a new vector.
The bear case starts with Datadog's structural advantages. Datadog is growing at 25 to 30%, expanding its platform more rapidly, pricing aggressively on competitive deals, and capturing cloud-native customers who choose it over Dynatrace's more traditional enterprise positioning. If Datadog's cloud-native customer base eventually becomes the enterprise standard as cloud-native architectures displace on-premise legacy systems, Dynatrace's differentiated enterprise positioning loses its moat.
NRR compression has not found a floor. Moving from 120 to 113 in 2 years, if that trend continues to 105 to 107, the land and expand model that made Dynatrace a premium software company breaks down. You need NRR above 115 to sustain 20% growth. Below 110, you need explosive new logo growth that the current sales motion is not delivering at the required rate.
And Guggenheim's downgrade is a credibility signal, not just a rating action. Guggenheim was a long-term bull on Dynatrace. Their reversal after this quarter represents an experienced analyst making a structural judgment about the business trajectory. When a bull capitulates, it often signals that the risks are becoming more consensus and the premium valuation multiple no longer has institutional support to hold.
Options activity on Dynatrace was heavily put-skewed following earnings, with the put-call ratio spiking to 1.45 on the session, the highest in 6 months. Put buyers concentrated at the $28 to $32 strike range for the August expiration, positioning for further multiple compression if Q1 FY 2027 revenue does not immediately show re-acceleration. The options market is not giving Dynatrace the benefit of the doubt on the conservative guidance narrative.
Implied volatility elevated meaningfully post-earnings, reflecting the uncertainty now priced into the FY 2027 outcome. The IV profile shows a market that is genuinely uncertain whether Dynatrace stabilizes at the current multiple or re-rates further down as competitive pressure from Datadog and Cisco Splunk drives continued NRR compression. The skew strongly favors puts over calls at current IV levels.
CEO Rick McConnell executed a pre-planned 10b5-1 sale in the weeks leading to Q4, a scheduled transaction rather than a discretionary sale. CFO James Benson maintained his full equity position. Thoma Bravo, the private equity sponsor that took Dynatrace public, continues to hold a stake. The absence of discretionary insider selling is modestly positive, though the 10b5-1 structure means McConnell's transaction was pre-scheduled without knowledge of the specific earnings outcome.
The primary catalyst for Dynatrace is a Q1 FY2027 revenue beat with raised full-year guidance. If the company reports $520 to $530 million in Q1 and raises FY 2027 guidance from $2.3 to $2.4 billion, the deceleration narrative collapses and the stock re-rates. This is the single most binary near-term event for Dynatrace holders, and it is approximately 12 weeks away.
AI observability new contract announcements would be a meaningful catalyst. Dynatrace has been in extended pilot programs with large enterprises deploying AI agents and LLM applications. If they announce a major enterprise win specifically attributed to AI observability revenue that was not counted in prior ARR figures, it creates a new growth vector that the current guidance does not include. The market would immediately add a premium for AI platform optionality.
The key risks are NRR continuing to compress below 110, Datadog winning competitive deals at enterprise accounts where Dynatrace is the incumbent, and FY 2027 guidance proving accurate rather than conservative for the first time in 4 years. Any of these outcomes would force analysts to reassess the growth multiple and pressure the stock below $30. Guggenheim's downgrade makes the market more sensitive downside confirmation than upside surprises right now.
That's the Dynatrace Q4 FY 2026 breakdown. Beats on revenue and EPS, down 13% on guidance, a Guggenheim downgrade, and NRR compression that the market cannot ignore. The bull case is conservative guidance and AI observability upside. The bear case is a structural slowdown in the growth engine. Subscribe to Charged Alpha and you'll know which side is right when Q1 FY 2027 reports.
Charged Alpha content is for educational and entertainment purposes only. Nothing you hear on this show should be taken as financial advice. We do not hold positions in the securities discussed unless explicitly stated. Always do your own research and consult a qualified financial advisor before making any investment decisions. This is Charged Alpha. We charge forward, so you stay informed.
Ooh, we do! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.